Thanks so much, everybody. Thanks to CoinDesk for putting on this fantastic event. My name is Alex McDougall. I'm the CEO of Stablecorp. And what we're tackling today is a massive problem that we all know, and some of this is going to sound cliche, and that's almost the point. There's this $4 trillion value gap that's sitting around in our banking system today. We think about it as this friction tax. It exists under the surface. It exists in a way that we can't necessarily see it in our daily conversations. We can't necessarily see it in our daily transactions because it's been obfuscated for so long. So where does this come from? It's really, really simple. In the physical world, if I hand you $1, you know that you have my dollar and I no longer have it. In the digital world, if I hand you a digital dollar, you have no idea whether I have that digital dollar to give you, whether I'm good for it, whether you have it, and this entire machinery of technology comes into play to basically help us hack that friction trust right now, or hack that trust friction. In the real world today, again, when we're physically together, we can trust each other. When we're virtual, as 99.9% of our commerce is today, that trust evaporates and it's replaced by all of this legacy infrastructure. Monetizing that trust is a $4 trillion opportunity. Big numbers slide. There's $3.3 trillion today of lost business because KYC and KYBing for our existing financial system is too hard, and people abort it all the time. We've seen numerous presentations today about this topic on KYB sharing, seamless friction enhancing, and adding the ways to get to the financial system more smoothly. $5.2 trillion. The funding gap for small and medium businesses globally of 65 million. The banks, there's not the data required to effectively fund all of these small and medium businesses. These are all friction taxes that exist in our current financial structure. $120 billion on FX and cross-border transaction fees. That's not even including the time of T+2, the time value of money that's locked up in this system. And global big data. The amount of data that companies today are actually monetizing on their own behalf is effectively negligible. There's this massive data market that sits behind the transactions that are being done by individuals and companies, and effectively none of that value is going back to it. All of these are friction taxes inherent in our existing financial solutions. So what's not the answer? We've tried TradFi unbundling, peer-to-peer lending, independent payments, but it all comes back to the same financial infrastructure and the same financial intermediaries. Not your keys, not your crypto. We love to say it, but none of us really want grandma, grandpa, grandpa co actually managing their own private keys in a vault in their backyard. We've seen the challenges around the full decentralization model. We've seen it in the tail risks inherent in all of the major DeFi. We've seen it numerous times today. October has been the biggest month for DeFi hacks. Fortunately, some of that is the not your keys, not your crypto thesis at play. But existing centralized crypto solutions aren't the answer either. We've seen Celsius, we've seen 3 Arrows, we've seen all of these people try and replicate bank structures using digital assets without that same type of regulatory structure, and that's not the answer either. So what is the answer? In current world today, our traditional financial structure has done an unbelievably good job of hiding all of the chaos. We call it obfuscating. And basically all of the innovation that sits on top of this mainframe and COBOL and mumps and all of these antiquated solutions ends up in this shiny front end that looks like instant settlement, that looks like these really types of automated commerce, but it's really just masking a pure manual chaos that sits below it. And it's masking it with this $4 trillion of slosh that sits around the system. What's incredible about Web3 and what we have this amazing ability to do today is to really actually have the innovation sit below the surface. Yes, it's complex. Yes, it's very advanced technology. Yes, it is very hard to map it all together. But unlike today's financial structure where all of the innovation is just smoke and mirrors on top of monkeys on typewriters, the innovation in digital asset land is actually starting at the bottom. And so when you look at a crypto solution today, it often looks like, wow, that's not what I'm looking for. There's way too much tech. There's way too many weird errors. There's stuff that I don't understand. And so, but the actual innovation is happening below the surface. So shifting the model from this obfuscation of manual chaos to this abstraction of really, really high functioning automated chaos is really where the actual solutions are around unlocking this $4 trillion. So when we have the shiny front end, it's a last piece. When we get to the point where grandma and grandpa and grandma co and grandpa co can look at something that looks like a bank account and has all the same functionality, but it's all digital asset rails underneath, all the way down to the L1s, that's when that $4 trillion gets unlocked. And until then, it's really, really challenging to do. So let's double click a little bit. Abstraction on steroids. When we look at what we need to get to as part of the digital asset solution for the next generation of unlocking that growth, we've seen numerous slides today of where crypto is versus where the traditional economy is. And really, to get that next layer of growth, we need to create those solutions that are equivalent in all of the UX and all of the front end of what we're used to on our traditional banking structure today. But without having it be one company. Jeremy Krantz made a fantastic point. There's no one company in the world that's going to do the R&D to create this entirely new structure. And so it's this open source composable ecosystem of solutions with the technology layer that binds it all together that basically allows you to have this bank-like functionality using a network of solutions that are all in your own name, all transparent, all having the blockchain value propositions of trust and decentralization built right into them, but looking like a bank account. Cross-border payments, on-chain FX, programmatic payments, automated payments that go back and forth when something like a cell phone call happens and roaming. Things like that that currently in our traditional world take a ton of back end, a ton of back office, and a ton of reconciliation. All of those things need to be able to be done through a digital asset world, but end up in a front end that looks very similar to what we're used to. Insured custody, in your own name, not aggregated omnibus custody. Borrowing and lending, using data-driven models like the Clearbank model and a lot of on-chain models that are starting to come up today to minimize that $5.2 trillion value gap. All of the data that you're generating in this new Web3 world should be able to be accrued back to you and create credit models, create better underwriting, minimize that friction, and also attach the funding sources to it. If I'm a borrower, most of the time I also still have assets at rest, so I become a lender. Having those free-flowing types of credit assets, having those free-flowing types of treasury solutions. Digital asset exchanges, when you want to jump into alternate sources. All of this is bound together via 3 key things. 1, KYB and KYC sharing. When you onboard once, we need compliant, proper structures to be able to onboard into all of these other solutions in your own name, not one onboarding and then the megalith kind of takes over all of your assets. We need properly constructed digital assets, the stablecoin model that we've been working on. Really, if we're going to digitize fiat and we're going to replicate this, we're going to bootstrap some of the off-chain financial stability into on-chain world, we need well-constructed digital assets and we need well-constructed stablecoins. And ultimately, the data monetization. There's so much validated on-chain data that exists when you create these types of solutions. It's step functions more valuable than what data exists today for companies. And there's an entire gigantic market strictly around monetization of data that's completely opaque to the vast majority of users of our existing financial structure. So when we look at infrastructure for this, digital assets, borrowing and lending and data-driven credit models, properly constructed stablecoins, and ultimately the ability to access that data market. So how do I play as an institutional investor? We've seen numerous times today, especially on the institutional panel, around crypto is not put 1% of your portfolio in Bitcoin and forget about it. Crypto is something that goes through every single part of your portfolio. And this is a slide I showed to the CFA Society in Toronto a few weeks ago, and it is every part of it. Whether it's today, whether it's tomorrow, whether it's the day after, crypto is a huge part of any portfolio going forward. And what we're talking about here is it's infrastructure, it's venture capital. A lot of these are equity models with very straightforward business models that are attached to them. This is not crazy hard to get your head around how the value proposition accrues to some of these next generation companies. Slide 2. We're not going to get there from little incremental improvements. We're going to get there from exponential step function improvements. Huge cost savings. Alpha from differentiated sources of yield that is actually properly analyzed and run through traditional credit models. Huge enhancements in Sharpe ratio. That's one of the things that's come up a lot today from holding Bitcoin within a portfolio. And a huge increase in data revenues. So ultimately, when we take this away for the talkless, there's $4 trillion of market that actually sits behind monetizing this friction tax. It's not going to be captured by us not doing anything. The existing financial system will continue to trundle along just fine until we put all of these pieces together and start picking it apart by offering these step function value propositions to the traditional corporations and the traditional users of the world. We actually have the tech to do it now. It was impossible to unbundle using the existing technology stack. Now we have a brand new technology stack right from layer 0 all the way up that actually allows us to unbundle while still maintaining control, transparency, and all of the things that we love about crypto. The value will be in some of the point solutions, the individual service provider, but a ton of the value of this new world is going to accrue to the connective fabric, the KYC, KYB sharing, the digital assets that actually flow through it, and all of those solutions provider. So it's up to us and on this stage and in this room to sort of take those next steps, create those next solutions, and start picking away at this $4 trillion value friction tax. Thank you very much.